$65 billion. That's how much money Bernie Madoff claimed to lose when his investment firm collapsed in December 2008. But here's the thing. He never invested a single penny. For nearly 30 years, Bernard Lawrence Madoff ran the largest Ponzi scheme in human history from the 17th floor of the Lipstick Building in Manhattan. His client list read like a who's who of American wealth: Hollywood celebrities, hedge fund managers, country clubs, charities, and even his own family. They all believed they were part of an exclusive investment club generating impossibly consistent returns. In reality, they were funding the most audacious financial fraud ever conceived. Bernie Madoff didn't start as a criminal mastermind. In 1960, at age 22, he founded Bernard L. Madoff Investment Securities with $5,000 he'd saved from working as a lifeguard and sprinkler installer. The firm began as a legitimate penny stock trading operation, and Madoff quickly built a reputation as an innovative market maker. By the 1980s, Madoff had become a pillar of Wall Street respectability. He served as chairman of NASDAQ, sat on industry boards, and was regularly consulted by regulators. His trading operation was handling up to 10% of all New York Stock Exchange volume. But running parallel to this legitimate business was something much darker: an investment advisory service that operated from a separate floor of his offices. The investment advisory side was invitation only, shrouded in secrecy and exclusivity. Madoff cultivated an image of reluctant genius, someone who had to be convinced to take your money. He would turn away potential investors, creating the illusion that getting into his fund was a privilege. When he finally accepted clients, he promised steady returns of 10 to 12% annually, regardless of market conditions. The setup was brilliant in its simplicity. Madoff targeted wealthy individuals and institutions through a network of feeder funds, essentially middlemen who would pool money from multiple investors and hand it over to Madoff. These feeders, like Fairfield Greenwich Group and Banco Santander's hedge fund unit, earned hefty fees for bringing in new money, while Madoff maintained the mystique of being too exclusive to deal with small investors directly. How do you fake investment returns for 3 decades? Madoff's method was deceptively simple, but the execution required meticulous attention to detail and an army of unwitting accomplices. First, the strategy Madoff claimed to use, the split strike conversion, was real and commonly used by legitimate hedge funds. He would supposedly buy blue-chip stocks, then use options to limit both upside and downside risk. The beauty of this strategy was that it was complex enough that most investors didn't fully understand it, but legitimate enough that it sounded plausible to sophisticated money managers. But Madoff never bought the stocks or options he claimed to trade. Instead, he operated what investigators would later call a bank account Ponzi scheme. New investor money went into business accounts at J.P. Morgan Chase. When investors wanted to withdraw funds, Madoff simply transferred money from these accounts. When they wanted account statements, Madoff's back-office team would generate fake documents showing fictional trades and steady gains. The statements were works of art. They showed detailed transaction histories, complete with trade dates, prices, and commission costs. Madoff's team used real market data to make the trades look authentic. If the statement showed he'd bought IBM on a particular date, the price would match what IBM actually traded for that day. The only problem was that the trades never happened. To maintain the illusion, Madoff kept meticulous records of who had invested what and when. He tracked every dollar coming in and going out, ensuring that early investors could always withdraw their money plus the promised returns. This created a powerful word-of-mouth marketing engine. Satisfied investors would brag about their exclusive access to Bernie's magic touch, attracting new money to keep the scheme alive. The operation required an enormous amount of cash flow to maintain. Madoff needed new investments to exceed withdrawals every month, or the scheme would collapse. To ensure this, he cultivated relationships with feeder funds that could bring in hundreds of millions at a time. He also timed his marketing efforts around major market downturns when his steady returns looked even more attractive compared to the broader market's volatility. By 2008, Madoff was managing what appeared to be $65 billion in client assets. His offices occupied multiple floors of the Lipstick Building, employing dozens of people who had no idea they were participating in a massive fraud. The legitimate trading operation continued to generate real profits, providing cover for the fake investment advisory business. Madoff had become a celebrity in financial circles. He served on the board of directors of the Securities Industry Association, was active in NASDAQ governance, and regularly spoke at industry conferences. Regulators viewed him as a trusted partner, someone who understood market mechanics better than almost anyone on Wall Street. This reputation provided crucial protection when questions began to surface. Starting in 1999, a forensic accountant named Harry Markopoulos began submitting detailed reports to the Securities and Exchange Commission, explaining mathematically why Madoff's returns were impossible. Markopoulos calculated that Madoff would need to be trading more options than existed in the entire market to generate his claimed profits. But the SEC dismissed Markopoulos as a disgruntled competitor. When they did investigate Madoff, it was with kid gloves. Regulators would schedule visits in advance, giving Madoff time to prepare. They never asked to see actual trading records or contacted counterparties to verify transactions. The combination of Madoff's reputation and regulatory capture meant that the most obvious fraud in financial history continued undetected. The scheme's growth became exponential in its final years. Feeder funds were bringing in billions annually, attracted by Madoff's consistent performance during the dot-com crash and other market turbulence. Palm Beach country clubs steered their members' money to Madoff. Jewish charities and foundations, trusting in Madoff's reputation within their community, invested endowments that represented generations of donations. The end came not from regulatory scrutiny or investigative journalism, but from the simple mathematics of a Ponzi scheme during a financial crisis. As markets crashed in 2008, investors everywhere began pulling money from hedge funds and alternative investments. Madoff faced redemption requests totaling $7 billion, money he simply didn't have. In early December 2008, Madoff attempted to raise money to meet the redemptions. He approached several potential investors, but the amounts he needed were staggering, and his explanations for needing cash became increasingly desperate. When these efforts failed, Madoff realized the game was over. On December 10, 2008, Bernie Madoff called his sons Mark and Andrew into his office. Both worked at the legitimate side of their father's business and had no knowledge of the investment advisory fraud. According to their later testimony, Madoff told them he was finished, that the investment advisory business was one big lie, and that he expected to go to prison. The sons were horrified. After consulting with lawyers, they reported their father to federal authorities the next morning. FBI agents arrested Bernie Madoff at his Manhattan penthouse on December 11, 2008. He was charged with securities fraud, investment advisor fraud, mail fraud, wire fraud, money laundering, false statements, perjury, false filings with the SEC, and theft from an employee benefit plan. The scope of the fraud stunned even seasoned investigators. Court-appointed trustee Irving Picard began the massive task of unwinding 30 years of fake transactions. What he discovered was that of the $65 billion Madoff claimed to have lost, only about $20 billion had ever actually been invested. The rest was fictional gains that existed only on paper. The human cost of Madoff's fraud was devastating and immediate. Thousands of investors lost their life savings overnight. The Elie Wiesel Foundation for Humanity lost $15 million. Yeshiva University lost $110 million. The Robert Woody Lapin Charitable Foundation, which provided educational programs for Jewish youth, was forced to shut down entirely after losing virtually all of its assets. Individual victims faced equally tragic circumstances. Retirees who had trusted their nest eggs to Madoff's safe returns found themselves financially ruined in their 70s and 80s. Some victims committed suicide, unable to face the reality of starting over or the shame of having been deceived. The Madoff family itself was torn apart. Bernie's eldest son, Mark, overwhelmed by public scrutiny and death threats, hanged himself in his Soho apartment on the 2nd anniversary of his father's arrest. His suicide note read, "Bernie, now you know how you have destroyed the lives of your sons by your life of deceit." Bernie Madoff pleaded guilty to all charges on March 12, 2009. At his sentencing hearing, he offered a brief apology, but showed little emotion as victims confronted him with stories of financial ruin. Judge Denny Chin sentenced him to 150 years in prison, effectively a life sentence for the 71-year-old defendant. The regulatory response was swift but largely symbolic. The SEC faced intense criticism for its repeated failures to detect the fraud despite multiple warnings. Several officials resigned, and the agency implemented new oversight procedures. But critics argued that the fundamental problems, regulatory capture, insufficient resources, and a culture of deference to Wall Street, remained largely unchanged. Recovery efforts led by trustee Irving Picard have recovered about $14 billion for victims, representing roughly 70% of the principal amounts invested. However, victims who withdrew more than they invested have faced clawback lawsuits, creating additional legal complications and emotional trauma. The Madoff scandal revealed critical red flags that investors and regulators should have recognized much earlier. First, the impossibility of consistent returns regardless of market conditions. No legitimate investment strategy generates steady profits year after year without significant volatility. Second, the secrecy and exclusivity that Madoff cultivated should have raised suspicions. Legitimate investment managers are transparent about their strategies and welcome scrutiny from potential investors. When someone claims their methods are too sophisticated or proprietary to explain, that's often a sign of fraud. Third, the lack of independent custody and auditing. Madoff's firm held client assets, executed trades, and provided statements, a combination that eliminates crucial checks and balances. His auditor was a tiny firm operating out of a strip mall, hardly equipped to verify billions in assets. Finally, the feeder fund structure that brought Madoff most of his money created dangerous concentrations of risk. These funds earned fees for bringing in new investors but conducted little independent verification of Madoff's operations. Bernie Madoff died in federal prison in April 2021 at age 82. He never revealed where all the money went or provided meaningful cooperation with recovery efforts. His legacy stands as a reminder that in finance, if something seems too good to be true, it almost certainly is. The most dangerous fraudsters aren't the obvious criminals. They're the respected pillars of the community who use trust and reputation as weapons against their victims.